Please stay tuned for important disclosure information at the conclusion of this episode.
This is Destination Retirement with Robert Kuhn from Kuhn Capital Partners. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Robert provides his clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Destination Retirement with Robert Kuhn.
Welcome. My name is Robert Kuhn, and this is Destination Retirement. Thank you for joining us this week. It was a rather crazy week in the market. Last weekend was exceptionally crazy. Given the bank failures. And I wanted to spend some time on that today. I know I had a lot of conversations with listeners this week, and this is not the first time that I've been through a situation like this. So it's maybe the fourth or fifth. So I thought maybe what we would do this week is kind of go over my thoughts and what I expect to happen and what we're doing and for clients. And I think what individuals, investors need to do. And as you know, if you've listened to this show in the past, our job is to provide a profoundly different wealth management, investment management experience. And it really doesn't matter the amount of money somebody has. You can have $50,000 or $50 million. I think in times like today and in times like what we've experienced over the last week or two, when you have a good advisor in place, and we'll kind of go on that. We'll touch on that here in a little bit as well. I think the job of any advisor is to find out what your biggest risks are in retirement or as you get near retirement, and then make sure that we're hedging away, those risks. So if you want to have a conversation this week, please just give Paige a call, 630-492-1912, 630-492-1912. She'll set a time for us to talk this week. And always visit the website, KUHNCP.com, KUHNCP.com. We do podcast every episode. So if you want to listen to past episodes or this full episode, you can do that by going to the website and then clicking on the radio tab, and then you'll see all of our episodes there. So really great. I mean, the downloads are certainly up and to the right. I think that means that we're doing a good job educating. So last weekend was just a normal weekend, and we had a little bit of risk on Friday, obviously, with Silicon Valley Bank. And then if you're on Twitter, like I am, I probably spent more time on Twitter last weekend than I have in some time. But there was a lot of panic and there was a lot of fear. And, we go back to, I started in this business 96, 97, and I was just a new person, just licensed way back then. And I dealt with the long-term capital hedge fund debacle and the devaluation of, global currencies to try to save what was supposed to be the smartest PhDs in the room. And clearly that wasn't the case. And then we had 2000, 2001, 2002, and then certainly 2008. And we had COVID in 2000. And here we are talking about failing banks again. I think different than, certainly in 2008, but headlines are the same. Stress is the same. And, it's very concerning to me that the conversations that we're having and that we had this past week, when banks were failing and, the market was, I don't know if crashing is the right word, but there was so much risk, so much fear of contagion, yet many people didn't hear from their advisors as far as what the plan was. And I think a lot of the clients that we work with in our quarterly reviews, they understand that, we still have many of the strategies that we utilize still have a heavy cash position. so they can use opportunities like this to, pick up assets, world-class assets, hopefully on sale. But this is the problem with traditional financial advice. Risk happens so fast. Just look at what happened last week. Everything was fine. Next thing you know, banks are failing. Regional banks are failing. Run on the banks. And, a run on the bank today is simply opening your phone and, clicking a button to wire money out. And then you get on social media. And if you're on Twitter or any of the other, a lot of the social media out there, a lot of the headlines, a lot of the articles were very, very, very scary. Yet you look at what institutions do, and they're immediately preparing for it, raising cash, ask questions later. Yet and this is something that we've talked so much about on this show, is that the only segment of the market that has a buy and hold strategy are individual investors. Those with $50 million to $10 million. I mean, it's, if you're not, and we've often talked about, the need for protection. I mean, I think that goes without saying. That I don't, I had a conversation with my oldest son this week, and it was, we were talking about, retirement, and for those investors that are in their 50s and 60s and 70s, and, how must they feel in a week like, what we just went through? Personally, I love it because I'm 48 years old, have cash to put to work, and tremendous amount of money can be made in volatile markets. But it can't be made if you're with a traditional financial advisor that simply has a buy and hold strategy. And when you have a buy and hold strategy, again, it works 70 to 80% of the time. But what about the other 20% or the other 25% or the other 30% that you have to have a situation, or you're faced with a situation like this, you reach out to the advisor and they just act like nothing's wrong. Oh, it's fine. It's going to come back. Don't worry about it. And it's like, my goodness, if you're not going to play defense in this type of a market, when are you? And so those are the advisors that we're taking business from. We're taking business from advisors who simply believe that clients are naive enough to just sit and take it, just sit and have a buy and hold philosophy, and no proactive, money management, no reactive money management, because at the end of the day, your job as an advisor is to protect your client's assets. And, we often can look at, a profit and loss statement for money that we're managing, and we can immediately determine, whether we're good or bad or not. But what we can't see is the psychological effects of somebody who has $500,000, $1 million, $2 million, $3 million, and they see in years like last year, their safe money go down 20%, their equity money go down 25%. Then this year, the market is obviously down, and then, banks are failing and regional banks are having issues. And, is there any safe bank? All the money's going to, the money center banks, generally you hear the top four. And they want to know, what is going on and how are we going to weather through this situation, but not only weather through it, but how are we going to take advantage of it? So 630-492-1912, 630-492-1912. If you want to have a conversation, Paige will set that up for us this week. But what we can't see is psychologically, how does that make you feel? And so when I was having the conversation with my son this week, who runs a hedge fund and deals with, ultra high net worth clients. And, we were just, talking that, at 48 and, Andrew, who's in his late 20s, it's, these are opportunities. These are fantastic opportunities to make sure that, we have, we can make money. And, there's just absolutely tremendous opportunities, tremendous bargains. But the problem is, what about that investor? Think about it. What if you're fully engaged? You have 100% of your money invested other than a few percentage points so you can pay the advisor fee. How is that supposed to make you feel? How is that supposed to allow you to take advantage of these types of volatile markets? Because as we've mentioned a million times, you can get rich in bear markets. You just don't know it until, the market's over or the bear market is over. So how are you feeling psychologically when you're working with an advisor that is truly not very proactive, keeps you fully engaged? I don't know if there's ever a reason to be fully invested. I mean, what is your hedge in your portfolio? And I know we've talked a lot about, what is your margin of safety? And that piques a lot of people's interest when I ask, what's your portfolio's margin of safety? Well, here we are again, another issue with the banks, and another issue where banks are having to be, I don't know if bailed out is the right word. I'll leave that to the politicians and those people that, without the government right now, the banks are going to look tremendously different. So what's your margin of safety? What hedge do you have in place? Unfortunately, a lot of this falls on deaf ears when the markets are doing nothing but going vertical, because you listen to an advisor that says you're fine, we're diversified. That is garbage. I mean, I don't know what diversification means if you're fully invested and you own equities and you own fixed income. That's not diversification. So it's time that investors who have really just, find their money, and, it sounds so condescending, but if the money's important to you, what are you doing just sitting there working with an advisor that has no true active management strategy in place? What more do you need to see that benefits the advisor far more than it benefits you? Because this garbage that you can't time the market, since when did timing the market become, I want to get out at the top, the top and get back in at the bottom? Yes, that can't work. But does that mean that you can't play offense and defense? Does that mean that when banks are failing that you shouldn't have an immediate sell to raise 20, 30, 40% of a portfolio? And, at least make sure that we're protecting clients' assets. And then opportunistically, if we see further selling, to use that as an opportunity to, take advantage of the volatility and pick up, world-class companies, hopefully at a much lower price. But unfortunately, it's just, advisors are good salespeople, and they make you feel stupid, and they make you think that they're the smartest guys or gals in the room. And the reality is that's just simply not the case. And if you have a strategy that only is buy and hold and you're fully engaged, you better just, strap on that seatbelt and get ready for the roller coaster, because, again, here we are, 2023, dealing with bank issues. In 2024, 25, it's going to be something else. 26, 27, it's going to be something else. 28, 29, it's going to be something else. And you're just simply at the mercy of the market. And in this market, in this environment, that's simply not good enough. And, making changes and giving yourselves a level of safety, a level of margin of error, and being able to psychologically understand that if you have your income needs met and you're not having to pull out money at lower prices, because we, haven't even talked about, that effect, because when you're taking money out and you're then that's just less money that you have to ultimately make up the for the portfolio to grow, and you just have to do greater numbers because it's less principal that ultimately is in the market. I think now, hopefully, after this week, that you now want to reach out, and whether it's me or somebody else, and have a conversation that buy and hold, again, 70 to 80% of the time, it's probably great. But you need to have an additional strategy. You need to have an additional manager that believes in active management, that can immediately press a button and, make sure that they're safeguarding, clients' assets, rather than just giving the same old, excuse of don't worry, it's going to come back. So a lot to get to this show. You're listening to Destination Retirements. My name is Robert Kuhn. If you'd like to have a conversation with myself this week, give Paige a call, 630-492-1912, 630-492-1912. More after the break.
Are you considering buying an annuity? Or did you buy an annuity because you were promised stock market-like returns with no downside? If you own the wrong annuity, there is a great chance you've experienced little to no growth over the past few years. In many instances, the insurance agent received more in commission than many have in actual investment growth. If you'd like to learn more about our annuity repair strategy, please call Robert 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirement. I'm Robert Kuhn, and I also am the host of this radio show, Destination Retirement. Our job is to make sure that we're actively hedging against your biggest risks in retirement and making sure that we do our job, which is ultimately to protect your hard-earned money and just make sure ultimately that your life and your livelihood and psychologically that weeks like last week, that we're protected and that ultimately we're going to use it to your advantage and take advantage of the market, use it for your advantage and make sure we take advantage of the market and then, make money because a tremendous amount of money can be made in these types of volatile markets, but not if you're fully invested. And hopefully by now, again, who would have thought that we'd be talking about bank failures and bank crisis that, that we would, be here, in just early 2023. But hopefully you recognize now that buy and hold benefits the advisor much more than it benefits the investor. That's at least our opinion. And I think it bears, the facts, make, just show you that it's, over and over again, that how many times can you take kind of chaos? And so here's what we want to do. And I've put a lot of thought into what it is that we do for clients. And I want to go over that this segment and give you, some ideas on kind of what to look at. So if you want to have a conversation with myself this week, just give Paige a call. You can do that by calling her now at 630-492-1912, 630-492-1912, and she'll set some time for us to talk this week. We're talking to a lot of people that, called in 6 months ago, 8 months ago, a year ago, 2 years ago, and I get it. A lot of times it's, the market's just going up. You think your strategy is the best because either A, you're doing it yourself, or B, you have the best advisor in the world because they just keep making money. Well, hopefully you realize now that it was the market and it necessarily wasn't the strategy. And it's, something that we want to make sure we're having, conversations with. So if you've reached out in the past and you didn't end up working with us, no worries. I mean, again, we believe in education, and we had many clients come on board this week that we talked with in the past, and it just wasn't the right time. And, for whatever reason, and that's fine. And a lot of times when you see the markets do what they did, that now all of a sudden becomes the right time. So give Paige a call, 630-492-1912. And, one of the things that I think it's so important when you meet with an advisor is to ask, how did they manage their money? And what has to happen for them to make changes to their own personal asset allocation? Isn't it, the analogy that if your neighbor loses his job, it's a recession. If you lose your job, it's a depression. I think that's just a fantastic question to ask because that will show you everything that they believe. And, again, do you think that Wall Street and the big banks and the big brokerage firms, that they just, with their corporate money or their money that they're taking and investing, do you think they just sit and buy and hold? I mean, come on. I mean, absolutely, positively not. But yet, why do they push their advisors to do that? And I think it's really simple because they want their advisors out capturing new assets. It's really simple. It's a fee-based business that we're in today, annual reoccurring revenue. And any single business that you look for, that's what they want. They want that subscription business. They want that money that's coming in no matter what. So that's what this industry has become. And again, 60, 70, 80% of the time, it's a non-issue. But yet when you have that philosophy, and then we go through weeks like we just went through last week, that becomes an issue. And then you have to sit and listen to somebody tell you that ultimately it's going to be okay. If you look at the markets over time, I mean, what does 100 years worth of market data mean to somebody who may need that money in 5 years or 10 years or 15 years, or you're in retirement today? I mean, it should mean nothing, right? And again, it's just so much that's wrong with the financial advice business. And that's one of the reasons I think we attract the clientele that we do. Again, it doesn't mean that our equity bucket is not down, because it is. I mean, that's just investing. At times you're going to lose money, but I can promise you for the bulk of the strategies, they're not just buy and forget. They're actively managed. And you look at kind of some positions, and that's what I want to get into kind of this segment is, what is somebody to do? Well, first off, if you have a buy and hold strategy with an advisor, fire them immediately. Make a change. You can call us 630-492-1912. You can call somebody else, because what you have is not anything unique. If you have a buy and hold strategy and you're paying a fee for it, especially if you have mutual funds that are not, they don't have the ability to go to cash. And again, that's another topic that unfortunately goes unnoticed. 99% of mutual funds, if you own mutual funds, they have to stay fully invested at all times. And so that mutual fund manager could know that there was going to be a run on the bank, and the regional banks and, a couple banks in Europe, and all the banks were going to get decimated. It was going to, there was going to be another panic situation. Certainly hasn't been as bad as 08 yet, but he could have known that last 2 Thursdays ago, but yet they must both stay fully invested. So if he's managing your money and they know that a bank run is going to come tomorrow, they have to stay fully invested. And I have to ask you, why would you have that kind of money management style? I mean, in every aspect of your life, you should hedge. You do already. Everything you hedge. You hedge homeowners insurance, auto insurance, car, health insurance. I mean, the list goes on and on and on. How you're trying to protect against losses. But when it comes to your biggest asset, in a lot of instances, there is no hedge. The hedge is an advisor telling you, oh, you're going to be fine. I mean, it's like, come on, it's 2023. Really? I mean, how many times do we have to go through this? How many times are we going to continue to go through it? And then what is that going to do psychologically? Because with the evolution of obviously technology and computers and, hedge funds and other types of momentum, well, it's not hedge funds, but it's momentum-based strategies. That's why we're seeing, you can follow the money flow. And that's why we're seeing all of, a lot of these big swings. And so if you have that type of a strategy, you could stop paying the advisor. You could go down to Charles Schwab or Fidelity or Vanguard. Any of those firms are fantastic. And you can say, listen, I believe in buy and hold. I trust that the market over time is going to be fine. And I think this is the best way to grow my capital and compound my growth. Now, I completely disagree with you, but it's your money. So what I think is truly irrelevant, but don't pay an advisor for it, because you can go meet with somebody for free 4 times a year and save that fee. So here's what we're talking about, and we talked obviously a lot of reflection this week when we see markets like this. We're using them as an opportunity. As you know, we think about investing as protected growth and income, growth, and then opportunistic growth. Our opportunistic growth strategy, we're buying names, and we love this volatility. We absolutely positively love the volatility. To raise capital, we sold some, 3 names inside of our opportunistic strategy that were up the portfolio was up almost double digits, and we're able to now pick up some names that have been just absolutely decimated, good quality companies that when the air clears, and it may take 1 month, 6 months, a year, we're going to be really, really happy that ultimately we did that. So our philosophy, my ask of you, is make sure that you know what has to happen before cash is raised inside of your portfolio. If you ask an advisor that you're currently working with, what has to happen for us to raise cash, they should be able to say A, B, C, D, and E, like immediate, like rattle it right off. As soon as you ask, it's boom, 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 and boom. Here's what has to happen. And if that's not the case, then why are you working with them? I mean, we all want to be friends. We all want to, it's hard to break up with advisors, but why are you working with them? Because you're not giving yourselves the best chance to succeed. So 630-492-1912, 630-492-1912. So what do? Well, a couple things. There are a lot of strategies that exist today. And let's get this, strategies because of what something is called makes it good or bad. It doesn't matter what something is called. There's a pro and there's a con for every single investment. Hedge funds, pro and con. Stocks, pro and con. Mutual fund, pro and con. Annuities, pro and con. It really just is, what pro can you live with and what con can you not live with? And so our thought process on portfolio construction and making sure that we're managing a portfolio, especially if you're 10 years to retirement or you're in retirement currently, obviously income at some point is probably going to be an interest of yours. And so one real basic way to managing, kind of construct a portfolio. Again, we believe in protected growth or income. We believe in growth, and then we believe in opportunistic growth. So let's talk about that protected growth sleeve. You could either protect the principal. There's strategies out there. The banks offer them. Insurance companies offer them. But there are a lot of principal protected strategies that have great pros and certainly some cons that you have to consider. And I think it's the job of a good advisor is to just articulate those and then let you decide and then figure out how they fit into a plan. So the protected income, I don't know if there's anything, there's more peace of mind that one could have to know that your income is guaranteed. Whatever income it is that you need in retirement is guaranteed. And so what makes up that guaranteed bucket? Well, you've got certainly Social Security. You have pensions, assuming, obviously the pension is good. You have other CDs that you could look at, especially in today's market. Some guaranteed government bonds that have some pretty good yields. Annuities, they can provide potentially substantial income. And again, there's a pro and a con, and you have to know and work with somebody who can articulate those to you. But what peace of mind one must have that if you say, okay, I want 100% of my income guaranteed. Okay, fine. Let's take a look at your resources. Let's take a look at your Social Security, your pension, or any other guaranteed sources of income you have. And then let's look at how we can guarantee that income. Let's look at it. Does an annuity make sense? Does, government bonds make sense? Are there principal protected strategies that the banks are offering that make sense? So let's try to guarantee that income. And that may take, I don't know what it's going to take of your portfolio. It depends on what you have versus what your income needs are. But it may take 30% of your portfolio or 40% of your portfolio or 50% of your portfolio. But if somebody knows that their cash flow needs are met in retirement, then weeks like last week, you're probably not stressing. Psychologically, you're probably okay. And if you have a good advisor and a good advisor who believes in active management, well, then you have cash on your balance sheet. You have cash inside the portfolio. So ultimately, you can actually go and take advantage of the sell-off. You can take advantage of this, historical drops that we've seen in some just absolutely fabulous names, just simply because everybody pressed sell and they'll ask questions later. So that's in its simplest form is what's guaranteed your income. And some people might not need 100% of their income guaranteed. Some may need, 70% or 60% or 50% or whatever that number is. And just because, it's certainly great for the $500,000, $1 million and under client. But if you have $3 million, $5 million, $10 million, $20 million, don't think that strategy is not for you. Talked with a client who, an investor who had almost $20 million of investable assets and just put a ton of money in a guaranteed income strategy because that frees up other capital to put to work for growth. So we'll get back after, this break. We'll talk more about some defensive strategies that we're utilizing. I think you need to consider. Give Paige a call, 630-492-1912, 630 492-1912, and we can have a conversation this week. More after the break.
Would you like your portfolio to be more certain in uncertain times? These days, there are more questions than ever. Before we can get to the answers, we have a question for you. What do you want to accomplish? Understanding the bigger picture is the first step to helping you pursue your goals today, tomorrow, and for generations to come. To schedule a complimentary call with Robert, please call 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm, and yes, we are a fiduciary. Our job, as we always say, is to identify your biggest risks and make sure to the best of our ability that we are hedging against those risks, because those risks could prevent you from achieving whatever goals it is that you have. And so I think that's the job of an advisor. The job of an advisor isn't to handhold you and tell you that things are going to be okay during markets like we've been experiencing over the last 2 weeks. You need action. You need an advisor that's proactive. You need an advisor that understands that active management is needed sometimes. And if you believe in that buy and hold strategy, and if your advisor never makes changes and never is proactive with raising cash and playing defense, it's time to fire them. And it's time to go manage the money on your own, find a new advisor, or go and talk with Schwab, Fidelity, or Vanguard if you think that ultimately that's the best way to manage your money. We believe in active management, especially if you have over $100,000. So if you believe in active management, you want proactive hedges in place inside of your portfolio, and you want to work with an advisory firm that is not only a fiduciary, but believes in active management, believes in trying to identify your greatest risk in retirement, even if you're 10 years from retirement or if you're in retirement, then we're going to be a good group to talk to. So you can call Paige, 630-492-1912, 630-492-1912. So a couple talked a lot about, obviously, the market and a lot of the risk that, we're still now going through. And I just can't believe that we're, reading headlines again, so reminiscent of 2008. I was talking with a money manager, this week, and he said, "Were you around in 2008? And I'm like, "Oh man, I'm getting old for this business," right? I mean, I was around for, 96, 97 long-term capital and the devaluation of the Russian currency. And so there's been so much, but, it never is different this time. I mean, the reality is, risk happens fast, contagion happens fast, and it's happening faster than we could have ever imagined. You can wire out, just look at what happened with Silicon Valley Bank and, in those banks that were, that certainly was, a bank that was affected in First Republic. I have a fund and oddly enough, last week we signed DocuSign new accounts there, and now clearly, we're not, we're still in the decision-making process of what we're going to do, but risk happens, and risk happens fast. And I think, what we talked about towards the latter part of the last segment is, we believe in portfolio construction. We believe that you have to have protected income or protected growth. You have to have growth, and you have to have opportunistic growth. So the protected income side, I think there's a level of peace and just comfort knowing that no matter what your income needs are met, that you should take some money and utilize a strategy that can, in addition to your other guaranteed sources of income, Social Security, pension, etc., can guarantee the income that you need. And it's a very simplistic strategy. These are not, and the banks and insurance companies both have variations of these strategies. And so it's not like, we're sitting here saying you have to go with one or other, because there's pros and cons to both. I think it's the job of an advisor to craft a portfolio that, is going to suit your needs the best. And it may be the insurance strategy, it may be the bank strategy. But if you have that peace of mind of knowing that your cash flow needs are met, then what's that worth to you? I mean, what is that worth to you? You know, it's like I look at and I talk with a lot of my friends, you know, I'm 48 years old and, you know, the bulk of my friends are somewhere in my, you know, where I'm at currently age wise. And it's like, you know, what's an extra whatever dollar it is? You know, do you really want to make an extra $50,000, $100,000, $300,000 a year? Or do you want to, you know, spend that time with your family or spend that time doing things that you enjoy? And a lot of times, you know, again, it's just that peace of mind, right? Well, you know, the market could shut down and somebody in their 40s and even, you know, early 50s, we can reinvent ourselves. I mean, let's just say hypothetically, you know, they say no more advisors. I mean, clearly, I don't think that would be the case, but I guess nothing would surprise me in this world anymore. But you know, as of tomorrow, there's no more advisors. Okay, fine. You got to manage some money on your own. Well, I can go and reinvent myself and figure out, you know, how I can do something that helps people or figure out a way to make money for my family, right? But what about that person that's 5 years from retirement or that investor that's in retirement or, you know, in the second half of retirement? You know, what do you do? What do you do if you see your portfolio go down 20, 30, 40%? And it just amazes me how people don't have an income strategy in place. So many people are using just reverse dollar cost averaging. You're just taking money out of your portfolio to live on. And, you know, you look at the probability analysis and an advisor may sit down and say, listen, 90% of the time you were perfectly fine. Well, what about the other 10%? I mean, it happens. And if you've learned anything, you know, well, me over the last 25 years, but especially, you know, just going back to 2000 and the whole COVID mess. And then here we are, you know, already, you know, in 2023 and we're dealing with bank issues again. I mean, so if you've learned anything, it's those anomalies exist, right? So if you don't have a guaranteed source of income, and again, it doesn't matter if it's insurance or if it's the bank strategy. Now, if you have 5 million, 7 million, 10 million, 15 million, you're going to use those strategies a little bit more opportunistically than a client who may have 100,000 or 500,000 or 1 or 2 million, right? But if you should have that because that will free up capital to take advantage of, you know, chaos in the market. Because I've heard it all the time. I want to wait till the market goes up to make me feel good to get back on the market. Well, I mean, yes, as a human, that makes all the sense in the world. As an advisor, it's the dumbest thing I've ever heard because what makes you feel comfortable, right? The market going up. Well, then you're missing 5%, 10%, 15% of the gains. But again, I understand that. And yes, the human side of me makes complete sense. But what if you didn't have to make those decisions? What if you had a strategy in place that already planned for that? I mean, just basic putting stops in. You know, one of our portfolio managers that we utilize, you know, they got stopped out of a lot of positions this week. And so now they're heavily cash. That's a beautiful thing. What does that mean? That means when you buy an investment, you have a predetermined level that you're out, no matter what. No questions asked, no thinking. If I like it, if I buy something at, you know, hypothetically at 30, and for whatever reason it drops to 25, you're out. I mean, just out. And those are the types of strategies that's a very basic way to manage risk is you have equities that have predefined stops in place and you're able to then take the emotion out. And what's the worst thing that could happen? You miss a little upside. Big deal, right? I mean, absolutely big deal. And the investing philosophy that I've always subscribed to is you never go broke taking a profit, ever. But yet when you look at Wall Street and you look at retail financial advisors, they'll tell you when to buy something all the time. They'll never tell you when to sell something. I mean, it's like, you know, that to me, anybody can tell you when to buy something. It's the ability to sell at predetermined times, whether it's on the upside or the downside, that makes you have a great strategy. You know, you look at these investments, and when you go into an investment, at some point, the investment is either going to go up or it's going to go down. So the risk reward characteristics of that strategy, of that investment, are going to change. So if I put money in a stock at 10 and it goes to 20, Well, do I ring the register? Did the risk profile change? Do I at least take off my initial investment so we're playing with house's money? I mean, what's the philosophy there? Well, the philosophy is, you buy and hold it, and you don't have an advisor because he's got, they have, 1,000 or 500 or whatever accounts, and they don't subscribe to active management. So they're not, set up to run model portfolios and take profit. When they take one, they take it for everybody that's in that portfolio. So what inevitably happens is you see on paper, you made a lot of money, but then markets like this week happen and you give it all back. And that has to feel worse, in my opinion, than losing money, because you had the money, but yet you didn't have an advisor that paid enough attention to detail that just simply subscribed to buy and hold. And here's what buy and hold is. Again, 70 to 80% of the time, it's fantastic. But here's why I say that it benefits the advisor always, because they're out getting new clients. They're out raising new money so they can charge a fee. So their revenue goes up, their personal revenue goes up. And that, unfortunately, once the industry switched from commissions to fees, it became a challenge, because you used to be able to market somebody's ability to give you good advice immediately. If I call you and say, hey, we're going to buy this, we're going to sell that, or we're going to sell this, and we're going to buy that. Well, you knew that the next time I called you, you're going to ask for an accounting of, hey, how'd that last trade go? Well, if I keep giving you bad trades and you keep losing money, chances are you're probably going to stop taking my advice, right? But once the industry went to fees, well, now all of a sudden, the buy and hold philosophy came in. Just buy, you can never play defense, Mr. Advisor, Mrs. Client. Even though Wall Street does it with their own money, the advisor probably does it with his or her own money and family money and whatnot. But when it comes to you, we're just going to tell you to buy and hold, sit and take it. Don't worry about banks failing. Don't worry about losing 30%. Don't worry about missing out on tremendous opportunity to make money, because I'm too busy trying to find my next client. So, that's unfortunately an oversimplification of what I think is happening in the industry. And I just wonder at what point do clients or investors recognize that that's just not good enough. So you're listening to Destination Retirement. If you want to have a conversation with me this week, please do that. You can call Paige at 630-492-1912, 630-492-1912. She'll set some time for us to have that initial call next week. More after the break.
Hoping is good. Knowing is better. You are unique, and your investments and plans should reflect that. Investors today want defined outcomes, not investments that simply track the stock market up and down. Did you know most of all mutual funds and managed accounts by prospectus must stay fully invested no matter how good or bad the stock market is? There is a better way. We want our clients to use portfolio gains to compound their investments, not make up for portfolio losses. Schedule a complimentary call with Robert. With Kuhn Capital Partners, partnership isn't just a promise. It's in our name.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I'm the president, founder, and portfolio manager of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. And yes, we are a fiduciary. Everything we do is to try and provide good outcomes, lose less when the markets are down. And if you've heard anything this show, and I probably am repeating myself a whole lot when I listen back to this show, it's probably going to drive me crazy, but that's okay, because I know that people don't listen from start to finish unless you're one of the 700-800 people that download the podcast each week. And we want to get that to 1,000. We want to get that to 15,000 and 2,000. And that ultimately is my goal. But, so I'm probably repeating myself, and I'm not going to apologize about it this week, because I think it's a job of myself, a professional who is on the radio, who's giving investment advice, that, we just give you, ways to cope through, these types of markets. And so if you want to have a conversation with me this week, give Paige a call, 630-492-1912, 630-492-1912. And again, I want to thank everybody everybody who reaches out. It's not lost on me that I don't know you, and certainly you don't know me. And yes, I do the radio show. So maybe you listen a bunch and you kind of know my personality and whatnot. But it takes some courage to make a call to somebody and ask for help, especially if you're already working with a current advisor. And I would say 8 out of 10 of our clients are coming from people who already have existing advisors in place. The other, 2 out of 10, and that's just kind of random. I think that's probably pretty close, but obviously I don't have the exact statistics, but they're managing the money on their own. And I think when they see these shocks in the market, they've started to say, hey, I'm really smart. I own this or I do this, but my expertise is not managing money. And so those investors are coming to us as well. So we've talked a lot again, on protection this, week, and we talked about hedging. And we've talked about, just looking at, basic risk management. And, unfortunately, this business, I think, is very simplistic. I truly do. I think many advisors are full of themselves and they can't articulate complex topics. So they talk over clients and they don't listen to clients and they just want to hear themselves talk. And, they just want to be the smartest people in the room. Well, the reality is that, just look and see, were you buying investments, inside of your portfolio over the last week or two? Ask an advisor what the hedge is inside of your portfolio. And there are hedges today in the marketplace that can guarantee income, that can guarantee principal. Insurance companies have them. Banks have them. I mean, there's a 2-year bank note from J.P. Morgan that I'm going to be plus or minus here on the percentages, but it was a 2-year bank note, 100% principal guaranteed. And over the 2-year period, you got a max gain of 18%. I mean, think about that. So if you break that, some people say, so I'm getting 9% a year. Well, maybe, but you get your total gain is 18% over 2 years. And it's principal protected. This one happened to be a JP Morgan banknote. As long as JP Morgan is still in business, then that banknote is guaranteed. Why aren't we having these types of conversations? Why are we not talking to investors about protecting, losing less, and then being opportunistic with a chunk of money? My favorite asset class, if you look at, obviously financial planning is key. Financial planning is really, when you reach out to us, generally what we'll do is talk about income. What are you trying to solve for? Why are you investing to begin with? Now, of course, we know why ultimately, but we want to know what your why is. Is it to maximize income? Is it to turn $1 into $10? Or is it to keep that dollar at $1 and just produce income for the rest of your life? So we want to know what your goal is and what you're hoping to accomplish. And generally, what we'll figure out first is if you're in retirement, we're going to talk about income maximization. We're going to look at your income streams. Are you dollar cost averaging out of your portfolio? And that's a very dangerous game to play when the markets are down. Or do you have guaranteed sources of income? And we're going to analyze those, and we're going to make sure that you have the best strategies in place. If you're not in retirement and you have 5 years, 7 years, 10 years, 15 years left to retirement, well, we're going to basically take your resources, what you think your goals are in retirement, and we're going to see if you're on track. And if you're on track, fantastic. If you're not on track, well, then we're going to have conversations. We're going to have conversations either or regardless. But the job that I want to know is, what are you trying to accomplish? And then the next question I'm going to try to determine, it's not going to ask you directly. I may ask you, but you may not have a good answer for it, but what is your hedges? What are your hedges in place to protect you from not experiencing or meeting that goal? And that to me is so critical. So many people came on CNBC this week when we were talking about the market. It just became a, kind of a right to make 15 to 20%, over the last, from 2009 to 2021. It kind of reminds me back to, the dot-coms where, in the late 90s, I had clients, we're up 25%. Well, what did we do wrong? It's like, we have to check ourselves here, right? And so we want to make sure that, we're putting in place the appropriate strategies to take advantage of and not be controlled by volatility. So yes, we have the protected bucket, protected income. We have clients that want to guarantee all their income. Okay, fine. There's great strategies, certainly some trade-offs if that's what you want to do, but it gives you that peace of mind, right? I mean, what's that worth to you? The growth bucket is very, very fun. If I look at kind of what bucket I like to manage the most, it's the opportunistic bucket. Easily, hands down, because that opportunistic bucket is a bucket that's unconstrained, can go anywhere. If you have under 2.2 million, we have to do it outside of our fund, which is fine. I mean, that's not a big deal. If you have either $1 million with our firm or you have a net worth, not including your house, of greater than 2.2 million, then we can put it in the fund. And those are just, that's where in my opinion, significant money can be made. And you look at the characteristics of kind of how we manage money in that opportunistic bucket. The characteristics of what we like to do are, excel or exceed in these types of markets. And to me, we're going to see these types of markets. I mean, these may be the norm. Now, maybe not banks failing, right? But, again, I didn't get back to something. I love it when I'm doing the show and I was trying to make a point. I forget the point and I go on to my next point, and then I remember what the point I was trying to make. I'm going to go back to that point because it was very important. We could see, it became a God-given right to make 15, 16, 17%. I was listening to a couple people on CNBC this week, and they said, well, when I got in the business, the Dow was at X, and it took 16 years for us to see any meaningful growth. So for those people that think that can't happen again, you're wrong. And I don't want that to happen again, but wouldn't you rather have an advisor that could manage through that and still make money during that period? Because if you have a buy and hold strategy, like I've said a million times on the radio show, you bought Microsoft in 2000. It took you 16 years to get back to even. 16 years. Yet they tripled, quadrupled their earnings during that period of time. There was significant money to be made. But if you had a buy and hold strategy, you made no money for 16 years. And here's the reality. You don't need to have a ton of money. If you have $100,000, I think we can really help you. And you have $1 million, $5 million, $10 million, $15 million, $20 million. Well, certainly we can help you. The more money you have, the more access you have to strategies. But I love working with that $50,000, $100,000, $150,000, $300,000 client just as much as I like working with the $5, $10, $15, $20 million net worth clients, because our job is, no matter what you have, we consider you to be rich. I mean, seriously, you have $100,000? Well, you're rich. I mean, it doesn't matter what somebody else has. That's what you got. And so we have to protect, we have to grow. And you look at inflation, are we in a stagflation environment? Well, I mean, it's starting to look more and more like that. Maybe that would be a good thing, right? I'd much rather be in that type of a market where we're still growing, but we're not, overcoming inflation rather than the market's going down 20 or 30%. But, if you have cash in the portfolio, and that leads me kind of that opportunistic bucket, there's times you can make money, and there's a lot of money to be made in bear markets. So I talked quick this week. I apologize if I kind of lost my train of thought, over, some periods, but this was kind of a shoot from the hip episode, because I'm tired of people losing money unnecessarily. I'm tired of people working with lazy advisors. I'm tired of people working with advisors that are not providing the true risk management ultimately that they thought that they had, but they don't have, because markets can go three ways. They can go up, they can go down, and they can go sideways. Most people listening are going to make money in an up market. Most people are going to lose money in a down market. And I don't know what is going to happen in a sideways market. Most people aren't going to make any money. There's money to be made in all three markets. That's why you have to have a philosophy, a strategy that has a protected strategy, a growth strategy, and an opportunistic strategy. So with that said, if you want to have a conversation this week, even if you reached out in the past and we never connected, no worries. We still want to talk with you. Give Paige a call, 630-492-1912, 630-492-1912. She'll set a time for us to have a conversation this week. More next week.
Thank you for listening to Destination Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Robert Kuhn from Kuhn Capital Partners. Call 630-492-1912 or visit them online at kuhncp.com.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.